Hi, my name is Virginia Stevenson, and today I'll be talking about the U.S. Treasury yield curve on one-year interest rates and its forecast. The yield curve for November 4th through November 8, 2013 was relatively steep and reflects the market's future expectation of an increase in implied one-year interest rates. Over the past month, the government shutdown caused the rates to increase because of the uncertainty in the market and investors' concern, causing yields to rise. The end of the government shutdown lowered rates, but since there could be a possibility of another government shutdown in the near future, long-term rates have increased. Yields have been rising since stated on October 30, 2013. The economy showed signs of underlying strength even as policymakers agreed to continue its $85 billion monthly bond purchases known as quantitative easing. Fidelity states that late last week, interest rates on 10-year Treasury bonds jumped to the highest level in 2 weeks. For the week of November 4th through November 8th, 2013, the yield curve flattened with the exception of Friday. Much of this was caused by the anticipation of the third quarter gross domestic product and the October payrolls. On Tuesday, November 5th, 2013, the price for the 30-year Treasuries fell after data showed U.S. service sector activity picked up in October despite the government shutdown, which caused a lot of uncertainty in the market. There was no significant economic change to cause much movement to the yield curve from Tuesday, November 5th to Wednesday, November 6th. Moving on to November 7th, Thursday, the second GDP number for quarter 3 came out and stated that the gross domestic product grew to a 2.8 annual rate, the quickest pace in a year. This was over the estimated 2% rate. This flattened the yield curve on Thursday. This is the second straight day that the benchmark 10-year yields have dropped, and this was the lowest that the 5-year notes have been since June. This movement resulted in the 5-year, 10-year, and 20-year U.S. Treasury yield curve forecast to also be lower because there's more money in the market, signaling stability. As you can see, on Friday, November 8th, the bond yields rose. This signals that the Fed may soon taper its bond buying program in the near future. With the yield curve's increase at the end of the week, it signals that the central bank could be scaling back its stimulus plan and the Fed could soon taper its bond buying program sooner rather than later. This news is forcing the yield curve, as you can see, at the higher end to increase. After observing the interest rates over the course of November 4th and November 8th, 2013, it can be concluded that the yield curve decreased slightly throughout the week until Friday when it increased. The yields are shifting upward, which shows future economic growth in the economy. As you can also see in the projected forecast, there is a decrease in the 10-year maturity date. This can be caused by a number of reasons, such as the future government shutdown due to the debt ceiling, expectations of the recovery slowing with the end of the quantitative easing, or Janet Yellen taking the position of the Federal Reserve Chairman when Mr. Bernanke leaves on January 31st, 2014. Mrs. Yellen is suspected to like low interest rates, and this could be causing the decrease. Thank you.